Hello, our beloved learners and viewers. It is teacher Shoppi Eria from Moon Education Services. You're most welcome to our lesson today. In today's lesson, I'm going to be discussing, we're still continuing with the topic of Introduction to Principles of Accounting, Senior 3 and Senior 4 work. So in today's lesson, we're going to be discussing bookkeeping systems. In my previous videos, I discussed the single entry systems. Remember, you have two systems of bookkeeping, the single entry system and the double entry system, or the dual recording. In my previous videos, I discussed the single entry system of bookkeeping, and today's video in particular, I'm going to be discussing the dual entry system, which is also called double entry system of bookkeeping. Now, in the dual recording or the double entry system of bookkeeping, we record transactions twice. Here it goes. This system asserts that for every transaction, there must be two accounts affected, the receiving and the losing account. Now let's take it in our own real life. When someone can't receive money when there is no other party that is giving out the money. So in this double entry system, transactions, you receive money if there is some other party that is giving out the money. So in this double entry system, a transaction is going to be recorded twice, as in the one giving and the one receiving. So one transaction is going to be recorded twice, and I'm going to be showing you how we record it. So it asserts that every transaction must be recorded twice, as in the receiving and the losing account. So take an example. If I say I withdrew, let's say I banked money. So if meaning I'm banking money, some let's say cash is, in that scenario, cash is being banked, and meaning the bank is increasing and the cash is reducing or losing out. So in that regard, we record those transactions two times, the account that is losing and the account that is gaining. That is the double entry system. Then under the double entry system or the dual recording system, we have what we call principles of double entry system. Now here I noted only two principles here. One says every transaction, there must be two accounts affected, meaning if a transaction is taking place, we have to note that there are two accounts that are going to be affected, meaning the debit side and the credit side. I'm going to be telling you the meaning of debit side and the credit side. Then the other principle is every transaction is recorded twice. The receiving account is dated and the losing account is credited with the same amount of money. Take an example. If I say I purchased, let's say, a motor vehicle at, let's say, UGX 40 million, meaning if I purchase a motor vehicle at 40 million, meaning I'm purchasing it with cash. So the cash, I'm going to give in cash and receive the motor vehicle. So you find out that one account is losing and one account is gaining. So in that regard, the account that is gaining money is dated, and the account that is losing out money is credited. Okay, then we have a note here also. Note to date. If you just hear the meaning of to date, dating means to date is to record the amount of the transaction on the left hand side of the account. Then to credit is to record those transactions on the right hand side of the account. So if they say date this account or date this transaction, meaning they are telling you to record that transaction on the left hand side of the account. Then if they tell you to credit, meaning we are going to record that transaction on the right hand side of the account. So in this regard, if they tell you, let's say, purchased wheat for UGX, let's say 50,000, and meaning we are purchasing wheat. So a purchase, meaning you're gaining the wheat and losing out the cash. So in that regard, we are going to be crediting the cash rather, and then purchase or dating the wheat or the purchase. So we are looking at recording the same amount of figure of one transaction. Let's say that wheat, the 50k is going to be recorded on the credit side of the cash account, and then on the date side of the purchase account. So that is it. So if they tell you to date, they're telling you to record a transaction on the left hand side of an account. So then if they tell you to credit, meaning they're telling you to record the same amount of money on the right hand side of the account. Then we have some notes here. The double entry system operates in the following categories of accounts as follows. I tried summarizing for you. Now I came up with the account class, the normal balance, then when it increases, and then when it decreases. We're going to be using this in our posting and applying to the ledgers and opening up accounts in the different transactions. So if an account, if it is an expense, in the normal balance it is dated. When an expense increases, it is dated. When an expense decreases, it is credited. So you're going to be following this during our posting. Then when the transaction or the account class is asset, it is under assets. In the normal balance, an asset is dated. Then if the asset increases, we date it. Then if the asset decreases, it is credited. So we're going to be following this during our posting and balancing. Then the liability is, if the account class is a liability, talk about an asset. In my previous videos I discussed the meaning of assets and liabilities. Now just to make a review a little, an asset just means an item, a resource, or a property that is owned by the business that aids in generation of income and profits to the business for a specified period of time. So if the account is an asset, talk about cash, talk about machinery, talk about anything, in the normal balance an asset is dated. But when the asset increases, it is dated. But when the asset decreases, it is credited. Then when it is a liability means a financial obligation or a debt payable by the business in a specified period of time. In the normal balance, liability is credited. Now when the liability increases, it is credited again. But when the liability decreases, it is dated. I told you the meaning of dating. If they said dating, meaning recording that amount of money in the debt side or on the left hand side of the account. And then crediting means recording a transaction in the right hand side of the account. Then if the account class is equity or capital, in the normal balance it is credited. But when the capital increases, it is credited again. Then when the equity or the capital decreases, we date it here. So you're going to be using this knowledge in the posting and coming up with different accounts. Then if it's revenue, in the normal balance, revenue is credited. When the revenue increases, it is credited. But when the revenue decreases, we date it. So this is the table we're going to be using in coming up with the different transactions. So that is our bookkeeping. Those are the principles of bookkeeping. Now I have some note here. There is this, how the double entry system works. Now the double entry system works in this way. Record all transactions that make the business gain money on the debt side of the account, and transactions that make the business lose out money on the credit side of the account for the same transactions. Then know which account is to be credited and which account is to be dated. So the double entry system works in this way. When you come up with an account, you should be able to understand which side is to be dated and which side is to be credited. Take an example. If I say purchased a laptop for office use, UGX, let's say 500,000. Now a purchase from our table is an expense. Now if an expense increases, we date it. Then if an expense increases, we date it from our table here. If an expense increases, we date it. Then if it reduces, we credit it. So just use this table to establish which account is to be dated and which account is to be credited. So back here, it works that all transactions that make the business gain money are to be recorded on the debit side of the account, and then transactions that make the business lose out money are to be recorded on the credit side of the account. Then you should be able to understand which account is to be credited and which account is to be dated. Now, this is what I'm talking about. I've come up with an example here. Let me show it to you too. I have a worked out example here. Worked out example 1. Now, Penina started business on January 1st, 2026 with cash 500,000. Now, this is a transaction. I'm just introducing you to how we come up with transactions or how we come up with the accounts. Now, Penina started business on January 1st, 2026 with cash UGX 500,000. Now, ask yourself, which is that money? Like in end, how do we call the money that we use to start up business? In most of cases, we call it capital. So, meaning Penina started business on January 1st, 2026 with the cash, which was capital 500,000. Now, as I've told you, first need to understand the types of accounts or the account classes in this transaction, and then extract the two accounts from our double entry system. Every transaction is going to be affected twice. This is one transaction. It's just started capital. It's just the business with capital 500. No. Now this is cash 500, but it was capital, meaning this is the 500,000 is the capital. Now here it says this implies that an asset called cash increased by 500,000. Remember our table, we say that if an asset increases, you come up to your table, back here to your table, and get it here. If an asset increases, we date it. If an asset increases, we date it. Come back to your table. If an asset increases, we date. Now, in this regard, it was cash 500,000, which is capital is also called cash. It is capital is cash, and cash is an asset. So an asset called cash increased by 500,000, meaning we are going to date cash because it was increasing, because it is an asset. From our table, we said if an asset increases, we date. So an asset called cash increased by UGX 500,000. Then an investment fund stroke capital by the owner increased by 500. Therefore, we date cash since it is receiving the UGX 7,000, and then credit capital since it is giving out or paying to the cash account. So in this regard, Penina started business with on January 1st, 2026 with UGX 500,000, meaning this amount of money was capital, meaning capital was issuing money to the cash account to be spent on the business startup. So capital was losing money to the cash account, meaning cash was increasing, and we said cash is an asset. So if an asset increases, we date it. Then if a capital, which is also equity, if capital increases, we also credit it. So in this regard, we are going to date capital, we are going to date cash because it was gaining money from the capital account, and then credit capital rather, because it was losing money to the capital, to the cash account rather. That is it. So this is our illustration, and this is how we come up with this. Now this is the double entry recording. Now it is one transaction. Here we are going to date the cash account and credit the capital account. So crediting the capital account because it is losing money to the cash account. Crediting capital means recording it on this credit side, as in the left hand side. So we credit capital as in record the same transaction, the same date, and the same amount here. So January 1st, he was receiving money from the cash account, or was paying to the cash account. Then the folio is ledger 2, and then the amount is the same. So we are recording this same transaction that Penny started business with cash this. We We are recording this 500,000 twice. So we credit it by recording it on the right hand side of the capital account, because the capital was giving out money to the cash account, as in it was reducing. So in the same manner, we shall date the cash account because it was gaining money from the capital account. So come and record it. Dating means we're going to date the capital account. Dating means recording a transaction on the left hand side of an account. So this is January 1st. He was getting money from the capital. That is the details. So it becomes ledger 1 as the folio, and then the amount is 500. So you're seeing that the same transaction is recorded twice, and that is the double entry system. Penina cash, it is 500. It is recorded on the credit side, and then dated on the cash account. So we have credited the capital account and then dated the cash account. So that is how the double entry system works. I'm going to be sharing more worked out examples for us to understand better the double entry system. Thank you for listening. Let's meet in the other videos about the dual recording or the double entry system. Thank you.